Brilliant, love that, thank you. And I love it when someone starts by saying, oh, I don't really want to MC, and then starts doing a bit of stand-up. I have all the time in the world for that. Anyway, guys, this is a topic that's really interesting to me. For those of you who don't know me, I wrote a book a few years back called Why DeFi Matters, and I used to work in the wealth and financial advice markets for a company called Citywire. And when I looked at how decentralized finance was transforming our industry, tokenization of assets was something that I thought was a very obvious development and improvement on the ecosystem that we have. So we have some really fascinating people here to talk about this. 4 very different perspectives, a fair amount of alignment, but also just coming at this topic from very, very different places. And I think if you stick with us, you'll get some really great insights today. So I think just to get us started, rather than going through CVs and telling us everything about yourselves, what would be really awesome would be to know, when you see this topic, what relevance does it have to you, and what are you doing in this space? And Jeff, let's start with you.
Relevance space. So while at the moment we run a spot exchange here in the UK, a regulated tokenized asset market, I think is a really important thing for the UK in general. So it's a space that while we're not offering it right now, it's something that is hugely interesting to me long term.
Amazing. And Henry, let's get your take.
Well, I think the world of commodities is one of the oldest that exists. Nothing about what we're doing is new in that sense, but there's a level of connectivity that blockchain and digital settlements is now allowed, which really does act as a game changer if you're trading products around the world. And I think that's what I'm incredibly excited about and what I'd love to build upon more together.
For sure, and just top line, so Agridex, for those that don't know, you're basically tokenizing commodities markets in African farming, right?
Yeah, Agridex is a digital marketplace built for the trade of agriculture and now mainly global commodities. If we think about the problems of a lot of producer nations around the world, especially in places like Africa or emergent Asia, they have a huge amount of barriers to trade, whether it's their settlement systems, their access to credit, their access to yielding products, or just their ability to digitize their paperwork systems. So it's an incredibly needful product.
Brilliant. And Sam, you're doing some fascinating things as well. I mean, the real-world asset space, when it started emerging, I was hearing about the tokenization of wine, whiskey, all sorts of fun and exotic things, and you're making the wine dream a reality, right?
Yeah, so we fall very much into the passion asset sector. My background is in wine investment, so I'm super familiar with the inefficiencies in this tangible asset class. I think we as tangible asset workers, we're like 30 years behind traditional finance. We are today where ETFs were to equities. And I think it's a huge opportunity to reduce some of these inefficiencies that are prevalent because we're dealing with something that is tangible, that is physical. We've got this amazing technology which brings everything into the same digital ecosystem. So for us, it's a huge, huge opportunity to bridge a very traditional, archaic industry into this Web3 crypto.
Amazing stuff, thank you. And Yaroslav, obviously you're coming at this from a different perspective. You're an investor. You also assist with tokenization of assets too. Tell us about what you do.
We do. We're the other side of it. So we invest in RWAs and tokenized assets. But we also realize there's so many projects just aren't ready, just pure investment. So we have a whole consulting and venture building business around it. So we have a lot of people come to us and say, hey, can we tokenize X? And our job is to poke holes in it, see if it makes sense from first principles. And if it does, we do it. Both to deploy capital or actually deploy the tech. And if it doesn't, then we don't. So I'm here to poke holes in the tokenization narrative.
Yeah, what's the dumbest thing someone's tried to tokenize?
Oh, what haven't we tried? Look, the most common ones have been, I guess, real estate and mining, weirdly. There's 2 of the ones, and those are the 2 biggest ones. The third one that...
They're the good ones, right? They work.
They're good ones with a caveat. The ones I'm most excited about is like trade finance, account receivables. These are the kind of lower hanging fruits, and I'm sure we'll go into more of that.
For sure. I think one thing I want to look at is how the market's been maturing, because this is a conversation we could have had 2 years ago when the space was a far more nascent one, and there was a lot of talk. Everyone was just saying, oh yeah, you can bring real world assets onto a blockchain, that's nice. But what's materially different now from, say, 2 years ago that's making this actually something that's coming to maturity? And that's an open question. Who fancies taking that first? Yes, go ahead, Sam.
Yeah, so I guess we've got to reference Uncle Larry Fink of BlackRock, who's done the biggest U-turn in history. 2 years ago, he was massively anti-Bitcoin, and now he's one of the biggest proponents of its praise. He said 6 months ago that everything can be tokenized, but doesn't mean that everything should be tokenized. We've already established. We had the tech 2 years ago for tokenization of really all types of RWA, all real-world assets. The thing that is on its way to changing is regulation. That's long-term. I think what has changed is UX, user experience. So up until quite recently, I used to always say on stage that education was the most important thing for like mainstream adoption. I've changed recently to realizing that it's user experience. The general population don't need to understand what the technology is. They don't care. They need to know that it improves their life, whether it's a return on your investment, lower fees, less friction, and they don't have to do it with a change of paradigm. They don't have to change their habits. And I think that user experience is what's changed very, very recently, piggybacking on existing infrastructure.
I think another thing that's been really interesting, if you compare what's going on now in the industry to what was going on in 2021, a lot of the reason why people got into ICOs, into tokenization and things, is they thought it was an easy way to get liquidity. So historically, you would almost engage in the process because you thought, well, this is easy money for raising by project. What we've seen is things to almost totally reverse. It's actually very hard to now list new tokens. It's actually very hard to access liquidity if you're going down the road of tokenization. But what you do have now is this suite of tools that make things so incredibly easy. And I think the biggest one that I'm always finding is the range and depth of stablecoin operations that are occurring. You know, if I talk about some of the areas that Agridex certainly is in, especially in merchant Africa. Even only 2 years ago, the only game in town was Tether, and the only way to do that was effectively through dark pools and swapping. People just accepting that there was this magical Tether. You wouldn't really have access in and out, and you were almost using a dark pool to recognize it. Now you have dedicated on and off ramps in something like 48 of the 54 African nations. You have an incredible depth of liquidity, not just in Tether, but also in USDC. And I think pretty soon we'll be announcing doing something ourselves around a stablecoin. So there's a lot more liquidity there, but there's a lot more real liquidity.
So it's kind of like real infrastructure replacing what was a narrative in 2021, what could be. We've got the infrastructure rails. It's matured a lot on custody, payments, off and on ramps. That real liquidity from existing TradFi actually now wanting to come in because the infrastructure is more matured. Now the infrastructure's here, we just need to build on it. And like you say, with the UX, the usability bit, not just for end world users, but for corporates and institutions that want to plug into it with their existing tools. A lot of that stuff just wasn't there 2 years ago.
Yeah, and you mentioned the institutional movement. I find that really interesting too, because we are finding that all the major traditional financial institutions are now looking at this technology and are actively working with it. How is that impacting the trust in the system as well? Because I think there was, go ahead. I think you can see what I'm speaking to here, because people would see things being tokenized, but it doesn't necessarily mean they trust it, right?
Yeah, Alec, I think the most tokenizing something is not hard. Legal and the tech side and the guys have said the infrastructure's there, it's not difficult. What's difficult is buy side. Who's buying your thing? So tokenizing isn't about creating kind of new water, you're just creating new plumbing for that water. It's not about tokenizing, it's about creating new financial reform, or infrastructure reform around what it is. Now the problem we had is that before, there's this weird digital asset thing that is a hybrid off-chain, on-chain, I'm not gonna buy. And if you look at financials, people don't buy with rationality, they buy with emotion. Will I lose my money? And it doesn't matter if you're an institution, you're a family office person. For instance, you need to allocate X amount. You will get fired if you don't allocate a certain amount. But you also buy IBM because you wouldn't get fired for buying IBM. So now we have, the BlackRocks, the Goldmans, most banks right now running a pilot on tokenization around stablecoins. You look at Tether and the Circle IPO. There's so much validation and social proofing around, I am not the first mover, my money is safe. So if I allocate here, I've got plausible deniability. If this goes wrong, it's not my arse on the line. So I think that from institutional standpoint, this is what's made it very kind of much more palatable. They still don't get it, but others don't come before and they haven't lost. From a retail standpoint, I mean, how many people in the room have previously bought private credit or invested in private credit pre Web3? No hands. Today, you can buy that with Centrifuge, or you can go to Maple, and you get exposure to private credit markets. You get exposure to account receivables, trade finance, right? I'm the boring guy who kind of loves this stuff, right? Fixed income. You don't care about it. All you care about is getting not your 2-3% in the bank, but 5, 6, 7, even 10%, across these DeFi systems. You don't care where it comes from, as long as you get your yield and you don't lose your money. That's what it comes down to.
Same thing with gold. 10 years ago, we'd have conversations, someone said, oh, but I can invest in gold today. You can, but have you? No, because you've got to figure out how to own physical gold. How do you store it? Where's the custody? How do you sell it? Now, go to MetaMask, buy PaxG, done. Like, you can, and now you will, because it's infinitely easier. Yeah, centrifuge, enable access to these assets in a way that, sure, if you knew how to, you could find them. Who knows how to?
Yeah, absolutely. And let's look at fractionalization, right? How is that meaningfully, bringing liquidity into the tokenization space? Oh, go ahead. You quick there.
Sure. So I think the big thing about fractionalization, especially when it comes to debt obligations, is people often want access to somebody's debt book, but they don't want the whole piece. We do a lot of receivables finance now. It's probably our biggest growth market at Agridex. And people want to come in and they say, well, I want to do a 50 grand ticket, but I don't want to be part of a group structure. I just want my own delineated piece of that debt. And if something goes wrong, I can call upon it. And I think that's
exciting. Or get involved in some sort of collective investment scheme.
Yeah, exactly. Or get involved in collective, or get involved in a DeFi protocol that then can send funds through it. And I think that's probably the biggest thing that's coming. Yaroslav was chatting about that just now. Historically, the only thing with real institutional grade scale has been Bitcoin. And I think the next step, the next big thing that will be genuine institutional scale of the trillions will be the debt market into tokenization. That will be the next step that breaches through that system.
Bring that barrier down to make it, like you say, you asked the room, who's bought this product before? Well, no one, because they're not trading at an institutional desk level. When you are able to fractionalize it and get rid of all the inefficiencies that $1,000 investor is just not worth offering that product to, when you can offer the product because it is tokenized and automated and all the work is done, all the efficiencies are there, and it's cheaper to go to market with, that's where greater sources of liquidity come from, making it more accessible to a wider class of users.
Yeah, and you can see there's obviously all the things are not all fully in place, but starting to be in place for mainstream adoption. I mean, the things you've touched upon already, UX really important, trust really important, having liquidity really important. Do we think there'll be a case though, obviously there are boom and bust cycles in Web3, there have been since it started, that perhaps tokenization starts to take off? Do you think there's a chance that people will start trying to tokenize things that don't make sense to tokenize and they won't have that liquidity and perhaps you'll have issues? Yeah.
I think they already are. We spoke about mining just now. My history before Agridex was I was a commodities trader. The hardest things in the world to run and to raise money for are mines. And there isn't a level of depth or liquidity yet in the token market for it to really make sense to me. I think a lot of people are trying and it's working slowly but surely. But most big mining projects are billions of dollars in investment. And I think to be able to say that you can do an ICO or token raise to be able to back that it's very ambitious, and I'm sure a few will work. But a lot of them will not be able to get to that level of scale.
If we're saying not just what are we tokenizing, but why, so my background is, as I say, in wine, so I can talk specifically to that. I've seen, and probably people here have heard of, 20 plus companies that are tokenizing wine. But why? What's the problem that it's solving? Selling fine wine is fucking hard. Adding a layer of tokenization on top of it, where they've got to on-ramp and create a wallet, what are you trying to do? That's buzzwords, that's hype. It doesn't do anything. The why is, okay, to improve accessibility, to reduce your cost transactions, to give you exposure to something that you otherwise couldn't have done, and to bring the liquidity on chain. I think it's important to also bring into this, and interested to hear your guys' views, what is ownership nowadays? Like we've had this massive shift in the last 15 years of how we consume social media, music, film, TV. We now don't need to own films and CDs. We rent them, we have subscriptions. Do you need to own these assets in the same way you used to, or do you just want to have economic exposure to them in a way that's legally enforceable?
That is a super good point, because there's so many ways to tokenize something. And I'll give 2 examples of how it could be done, the pros and cons of both. Imagine you have a big real estate portfolio. This is the current project for us in the UAE, for instance. You want exposure to UAE. And you don't want to buy the underlying real estate. You don't care about that. What you care about is the rental yield, whether it's residential, commercial, coming out of it. Let's say it's 10% annualized. What I want is exposure to the yield. I don't care about the underlying real estate, okay? So for instance, a project there could be, okay, great. Well, let's tokenize that yield, put it into a stablecoin, make it a yield-bearing stablecoin. So you can take that stablecoin, hold it in your wallet, get 10% exposure to this. And that is a much lighter way of doing it because you're commoditizing the cash flows, not the underlying security. What Henry mentioned as well is on point, mining. The bane of my existence right now, because mining is so incredibly high risk. You invest, essentially buying a mine is going to take 5 years to make that thing operational. It's going to take another couple of years for that thing to start producing output, and then maybe you're going to get a yield of dividends, right?
And you need to time the cycle.
And time the cycle, and exploration, all the risks that you have associated with that sector.
Yes, yeah. There needs to be a
You got to make sure you can find something as well.
Exactly. It's stupidly risky, but it's also labeled under stablecoin tokenization, which is the complete end of risk of the spectrum. You're basically investing into a vessel which is an early stage equity investment, which you're going to sit on for 5 years before you get any money out of it. So I think with all of these tokenization pieces, it's around how do you structure it, what do you want out of it, and how liquid. Because also one more thing I would say, you guys talk about liquidity, it's super important, but liquidity does not equal volume. That's very, very important. You can tokenize $500 million worth of real estate. Cool. Who's buying it? Right? And if it's institutional investors, great. Well, now they do want access to these things, and it needs to be structured in a more traditional way. And if it's retail, sure, you can now buy, real estate for, I don't know, $50 rather than having to buy, a penthouse in Dubai to get exposure to that if you want to. So
that was probably one of the, I suppose, promises of tokenization, is making illiquid assets more liquid, creating these secondary markets that can then have indexes on them or derivatives or whatever it's going to be. But no one is high frequency trading a commercial property. They might be acquiring interest in it. I really like the stablecoin example you gave, but they're going to get that exposure and likely keep that exposure. So really it's a liquidity event slowly over time or all at once. But then it's like, why wouldn't you just find the right investor to take that position? Just because it's got a secondary market doesn't mean it's going to be high volume and high liquidity and high transaction time. Often the time is, that's almost the selling point of tokenization, is that you could have the secondary market, but do you even need a secondary market?
And I think that's the other interesting point, which is like the amazing thing about tokenization is it often adds really easy levels of access. But the worry is it also adds really easy access to a secondary resale. And for a lot of these products that are not built to be held, and if they spike, people hold them, but if they don't, they dump them immediately. There is a worry that there's going to be contagion into too much liquidity and access points for people to exit out, and then you suddenly start to deal with a much lower valuation than you would have had probably going through a traditional market sense.
But with the liquidity, just one more thing to add. So you guys, is everything with MicroStrategy? And of course, what they're doing with Michael Saylor. A lot of the demand for MicroStrategy isn't people looking to go long Bitcoin through equity wrapper. That's complete nonsense, right? People, a lot of the old age argument is that more people have a brokerage account than have a MetaMask, right, or a Coinbase account. That's true, but the real demand, if you look at the volumes, they come from traders, essentially. People like gamma scalping and basically trading the options and derivatives on top of that. It's the same thing here, right? So you can tokenize assets, but you might have a lot of liquidity, but as Henry said, it'll be either static liquidity that's not going anywhere, or worse, it will be liquidity that can get pulled during a bear market. So what you need to do is create lending, borrow, yield markets on top of this, to plug into RWAs, the different lending protocols. It's like what Centrifuge did and MakerDAO. So they're using, I think, $400 million worth of accounts receivables coming from Centrifuge as the collateral to mint stablecoins on Maker. And you need to create those markets to actually create the buy side, we'll talk about the demand side, if you will, of these tokenized assets, because the supply side isn't enough.
Derivatives bring into the conversation. Tangible assets, half the time, value is locked up until point of sale. You could be dealing something that's held for 6 months while it's in a grain silo in Argentina. You could be dealing in something like whiskey that's held in a cask or something for 20 years. But there's no value until it's sold. It's tied up. And borrowing against these kind of assets is usually complex, expensive, questionable tax, depending on what jurisdictions you're doing it in. But bring it all into this ecosystem, and it's a plug and play. You speak to RWA. RWA will look at any asset that's, say, Ethereum-based and say, okay, this is the TVL, this is the interest rates, show me your offer document. As long as you're compliant, we can go for it. So it unlocks derivatives that previously weren't available against trillions worth of dollars that previously we couldn't tap into.
Yeah, and I feel like we're at the start of a cycle with this. Obviously, it's a great unlock. More things can be traded more easily. That means lots of good stuff will happen. It probably means lots of bad stuff will happen too. I mean, what kind of questions do you get asked here, Sam? Because you're trading a fairly esoteric asset when it comes to wine. So, when people are asking you, should this be tokenized, what do you say to them?
Okay, so esoteric is a good word to come on to. If you were to try investing in something like wine in current products, you've got to go through a professional who has the relationships, who has the knowledge. They've got the data to look at 250,000 unique wines and tell you what to invest in. You have to go to them to trade it, to sell it, and your exit, your liquidity is via them. Yeah, good luck doing it off your own back. You're going to lose versus the market. This potentially takes away from that. Sure, you tokenize individual assets, but bring it into a way that's scalable and accessible and liquid and all of those things. Turn them into a product that's like an ETF structure and develop it and distribute it on chain. Suddenly, customer A comes and says, okay, I want to get exposure to this market. Forget that it's wine. How do I do it? This market does 8% a year. This market does less than 5% average annual volatility. This market does low correlation. That's all I care about, and I want to do it for the lowest possible friction, the lowest fee, and I want a global secondary market. So you take away all the esoteric limitations. You just say, I'm buying essentially an ETF to a commodity, and yeah, it doesn't have to be wine. It can be classic cars. Can be a whole gallery of pieces of art. And maybe to come back to one of the earlier questions on fractionalization, what's the fractionalization for? Like, it's cool if you give fractional ownership to a single piece of art, a Picasso, a Monet, a Manet, but you're still limited to just a single asset. That's where's your price discovery, where's your secondary market, where's your valuation. But if you tokenize 500 pieces of art in a gallery or a museum and give a thematic portfolio off that, you, again, remove that esoteric limitations. I'm just getting exposure to Christie's, summer, spring collection. I'm kind of crossing over between different industries there. But yeah, it kind of normalizes or standardizes it somewhat.
But I think this idea that in our sort of world, fractionalization doesn't have the same level of liquidity always as the traditional world. I think a great example would be some of these raising groups that invested in Revolut very early on. They all had these tiny allocations to Revolut that has gone up hugely in value. None of them have ever been given more liquidity than about 10% of what the total valuation is. They're still locked in the same way as a lot of us worry that we're locked in different ways in the new rails. So liquidity is not what we think it is in any jurisdiction, in any type of institutional setup. But I do think that ours still needs greater depth, 100%.
Great stuff. And obviously, yeah, as you're saying, that locked-in point's really interesting. Liquidity is an interesting point. And also, that if things get tokenized, it will bring the retail market in, and retail investors typically aren't always the best at handling volatility or at handling any kind of twists and turns in the market, which probably brings in things like regulation. And I'd like to know from your perspective, seeing as you're actually operating in this space, do you feel like you have a great degree of clarity on what you can do in terms of regulation? And do you think we have regulation in place currently that will allow tokenization to scale in the way that it can?
Well, we operate in something like sort of 15 different countries, and in each different place there are often different rules. So sometimes you're regulated in a traditional fashion, sometimes you're part of a sandbox. I don't know how is it for everyone else, but the simple answer is there isn't full clarity. But there isn't full clarity in the traditional rails either. Most banks have multiple different licenses. They have multiple different regulation points. They speak to different ombudsmen. I think if you're working as a global product, which sounds like most of us are, you're never going to have complete certainty in every jurisdiction. The answer is to not let perfect get in the way of good.
That's a really good point. The perfect instead of good, I like that. But like you say, what do we have now? Where does it need to be? When it comes to these kind of token asset markets or TAMs, they're probably going to be locked jurisdictionally from the onset because you don't have a lot of cross-border regulatory clarity where regulation of UK matches up perfectly with Singapore, for instance. And you're going to have investors that, we're all crypto investors. Technically, we're all cross-border global investors right now. It might be on a global accessible level, but it might be more of a permissioned DeFi, permissioned token asset market. Now, it doesn't mean, I don't want to start a digital ID debate, but it might be if you're going to do the MetaMask route, you have to have some sort of KYC token, or it's going to be off the back of an existing exchange that has the regulatory approval to do fiat on-ramping and off-ramping and stable coins and offer these new types of products and assets in a tokenized form. just because it's tokenized and it sits in storage doesn't mean that the offering still doesn't have value and isn't going to give the yields across multiple asset classes that still has, interoperability. You want to sell off some of your, coffee shop portfolio and buy some Bitcoin. That's what the tokenization is for, using the infrastructure and using the rails to have a more diverse portfolio across multiple asset classes.
It's a lot better than it was 2 years ago. I'll give you that.
Why we're here.
The problem is this, and Henry, you touched on this, regulatory arbitrage. If you look at UAE, you have the DIFC. They have a sandbox for tokenizing real estate, right? They're very receptive. We know what licensing would need to get to do ABC, and there's a very clear path to it. Europe, frankly, I don't really touch Europe anymore. It's a bit more complex. But I think we're going in the right direction, but sometimes no matter how much legal advice you get, it's very difficult to be compliant with a rule book that hasn't been written yet. So it's best efforts, KYC, making sure you're doing the right thing. That's kind of the key part. The second aspect of it is there are still limitations. So let's imagine you tokenize, I don't know, a farm in Kenya, right, which produces wheat. And you create some sort of stablecoin on top of it. And the smart contracts say, I give you $1, I get $1 worth of this kind of, 1,000th of this farm back, which entitles me to 10% of the yield per year. Fantastic. Okay, what if things go horribly wrong? What if the thing is liquidated and you want to get your 1,000th of the farm? Smart contracts can dictate, what you should be getting financially, the output of the factory. They're not going to seize that 1,000th of the farm for you, right? Unless it is a programmable SPV, which can be dictated. So I think there's a bit of there's still a bit of a gap between the legal and custodial contracts versus the financial rules that can be programmed into smart contracts, stablecoins, tokenization, and that's what we're still missing.
Yeah, fascinating stuff. I've got a few more questions left, but I figure at this juncture, perhaps you've got a really engaged audience here. If anyone has any questions for the panel, feel free to raise your hand. I'm happy to take a few. Don't be shy. I'll keep an eye out. If no one's doing it now, I will keep an eye out as I'm asking more. You were talking there about different markets, different approaches. What do we think the long-term view is for tokenized assets? Is it a kind of global vision, or is it more a kind of interconnected network of more localized projects?
Well, I think it's like anything. If you look at some countries, they don't even have their own currency anymore, whereas some fiercely protect it. I think some countries will be incredibly forward-thinking. I know the UAE, Abu Dhabi especially, has all of these incredible structures for understanding and crafting new policy based on new steps. And other countries will be incredibly lackluster, and some will be downright aggressive against it. And I think that'll fit with the patterns of how they see the world. I just came back from a trade delegation in Bahrain, actually with Sam, and it was incredible, not just making friends with him, but it was incredible in general, because they were so incredibly forward-thinking. They were fans of helping you set up offices. They were going to subsidize people that you were going to hire. And then you get back to England, and you start to hear that stablecoins might be banned, or there might be controls on how many you can have. And you kind of see that there is a massive ebb and flow between different countries and how they view the world, not just the technology.
I think it's going to be localized first, global second. Whoever kind of nails it, gets it completely right, removes all of the inefficiencies, makes it fast to go to market for a new asset class or a new issuer wants to come on, then it's going to be, that's the bride of the ball, and everyone's going to want to date them and take them out. So whoever can kind of get that framework nailed first, other people will start to duplicate it. And once you get the duplication, we start to get regulators talking the same language. That's when you can start to go to a global level. But I think it's always going to be, is this asset class, is this product, is this tokenization right for that investor? And I think that's something that will just kind of never go away.
I think we have to say that it's got to be global, right? That's why we're all here. We believe in the vision that all assets are moving on chain, and it's going to become frictionless. And one day, we open up a single app. It's our replacement for our digibank, and in that single app, you've got your fiat currencies, you've got your tokenized mining shares, you've got tokenized commodities from farming in Africa, you've got gold, you've got wines, watches, whiskey. Absolutely everything's there, and it's represented in the same current account.
Like a real-time net worth.
Exactly, yeah, and everything's tradable peer-to-peer. There's no limitations. I mean, the tech is there today, right? Like among us, we know how to connect the tech. It's just regulation and UX and sales convincing everyone that is possible. I think we have to believe that that's the ultimate outcome.
I think I'll leave you guys with a bit of a picture, at least as I have it in my head. So you log into your Revolut, whatever banking app, and at that point you can say, hey, well, I've got a car, I've got some real estate, I've got some shares of an Apple, whatever, and I want to take a small loan, right, for a personal loan, whatever it might be, to either to buy, I don't know, a new conservatory or to invest into a wine ETF, right, or a set of asset classes. And you can do it like that. So the terminology of RWAs, tokenization will all be gone. It's just assets that are available to invest from a retail standpoint. You can very easily unlock liquidity from your house that you live in, or from the car that you own, or whatever it might be, or from the watch, a fancy watch that you have. And that will be easily accessible, usable, and composable, effectively, into different things. I think that's from a retail standpoint. From an institutional standpoint, it will just make things a lot cheaper, faster, and more accessible. And I think eventually, it won't happen now, but eventually, and Sam's right, everything will be more or less tokenized. It's not about, things will be tokenized. It's a question of should it be now. In the short-term debt obligations, so things like treasuries, T-bills, debt, account receivables, super easy, great, low regulation. The next level that's harder is around real estate, things that kind of come at the next tier. And the third tier will be super niche, super kind of niche things, or super, let's say, very regulated, very isolated markets that will then come on chain as well. And eventually, all of that will be tradable both for institutional and for retail. Again, obviously KYC'd, and they'll have certain checks and balances in place to make sure people don't understand what they're putting their money into.
Yeah, and I think you actually present a nice question for the rest of the panel as we get to the last minute or two of the session here, which is, move things along 3 to 5 years. Which type of assets will achieve mass adoption, as tokenized assets?
I think real estate is going to be huge. I think it's one of the most complex to get right. In my opinion, only Dubai has had the truly perfect version of tokenized real estate that's being commercialized, but others will follow very quickly, and the market's massive.
I think the big thing that will be set up within the next 3 to 5 years is tokenization of illiquid bourses. And what I mean by that is stock exchanges at the moment aren't allowed to take in international capital. So whether that's Cuba, Venezuela, Iran, all of these places at some point will be allowed to open up, and there will be a 1 to 12-month period where outside capital can't get in. And by having a tokenization product, it's like flipping a switch. People can come in instantly, buy into these environments without having to go through traditional banking rails, and that will be huge. That's the biggest thing coming.
That was the biggest thing coming, but maybe the lowest hanging fruit, tokenized money markets, replacing savings accounts. Instead of you putting your capital into a bank or a banking app, which is in a bank anyway, and you're reliant upon the Bank of England's base rate, which goes up and down like a yo-yo, very centrally driven, whereas money markets, they are there to move liquidity back and forth, and if you put your money in, you're getting a yield from that. There's some great apps that basically back the banks in doing that. Putting that sort of functionality in everyone's own wallet to be self-sovereign with their own funds and get a yield from it, I think that's the lowest barrier to entry, and I think that kind of tech could replace savings accounts and actually give a bit more democratization and power back to the users.
Amazing. So much to be excited about, so much stuff still ahead of us. But even in the last few years, it's clear that tokenization has really come on a long way in so many different ways. Guys, thank you. It was great getting all your perspectives. It's been a pleasure having you as a panel. And thanks, everyone, for listening in so intently. Everyone, please, round of applause for the panel.
Thanks, guys.